Hi everyone, you're all very welcome to this fundamental video. So in this video, we'll be looking at, I suppose, all of the key components within the financial markets over the last kind of 6-9 months or so, what's driving the markets from a fundamental perspective, looking at a range of different asset classes, and of course, divulging into all of these fundamentals, both from a fiscal policy, from a monetary policy, from interest rates, all the way through, I suppose, to the broader mechanics and the broader, I suppose, market movements accordingly. So it's going to be very, very deep, in depth. We'll look at the fundamental market correlation, so how different asset classes react off each other, and of course, take you through, I suppose, the key components of that as well. Of course, at the end, if you're watching this and you have any questions, please feel free to reach out to us and we'll be more than happy to assist. Enjoy.
Markets at the minute and having an open and frank conversation about everything. So what do we see invisibly in the markets over the last 3 or 4 months is, I suppose, a polar opposite reversion of what's been taking place over the last over the last 6 months or so. Okay. Now, broadly speaking, again, we can assimilate clearly into the markets that at the moment in time, we've got out of control inflation. We have a cyclical reversion in the market. So what I mean by a cyclical reversion is we're seeing a polar opposite effect as to what's happened prior to, let's say, 2020 into 2022. So if we look at the markets, and again, I'm going to divvy back to kind of some charts just to kind of drive home and maybe clarify some of the fundamentals happening in these markets. So if we look at, let's say, for example, I've here the Dow Jones, what happened over the last 2.5 years? Well, what happened initially was that COVID collapse. The markets ultimately sold off. And why did the market sell off? Well, the market sold off in reality off the back of the sharp and I suppose complete lockdowns that the global economy had. It was in the UK, it was in Ireland, it was in Europe, it was in America, it was global, right? The only economy that didn't really shut down was that of China, which is ironic in its own right. So what actually happened then, after that initial kind of 6-8 week selling in the markets, that collapse, we started to see the central banks get involved. We started to see hundreds of millions and billions and trillions of liquidity being pumped into the markets to steady the ship. Effectively, that's what happened. Then, as a result, then in the bifocal of that, and we'll talk about it later on, the central banks cut all the interest rates to zero. Now, the reason why the central banks cut all the interest rates to zero is to allow households and the broader mechanics of the market, so i.e. institutions, everything from your producers to your service providers and everything in between, to allow to be able to run its businesses, finance its businesses during the economic uncertainty that bestowed between February, March, April of 2020. So as a direct consequence then, as the markets flooded in with liquidity, what happened then? Well, you heard the narrative in probably 2020 and 2021 called "Don't Fight the Fed." So what actually happened is the Fed began rapidly pumping liquidity into the markets because their mandate, the Fed's mandate, and we'll see it at the end of July when it comes to their next interest rate meeting, is full employment and stable prices. So how they ensured full employment was by obviously introducing, from the government perspective, the different furlough schemes. So we saw it in America, we saw the $1,200 stimulus checks, we saw here $1,500 stimulus checks, I think it was. We saw it here in domestically in Europe, in the UK as well, where there was different furlough schemes where people were getting paid even though they weren't actually working. Now, in hindsight, yes, that's a great idea in the short term to plug this hole. Okay, so when you think plugging holes, you think round pegs, square holes. And what the different central banks and governments had to do was to basically make sure that there was no leakages or no, I suppose, systematic failures in the price action, broadly in the markets, but also in the broader economy as well. And as a direct consequence, because of that, the markets rallied. So this is why we saw the S&P, the NASDAQ, the Dow Jones, all these different indices, the DAX, the FTSE not so much in the UK because it's more of an inflation indice, but all the primary indices globally rallied. Okay, we rallied somewhat in that 2-year period. We probably rallied anywhere between kind of 100 to 150%, right? If we look at our mechanics here on the Dow Jones, from those COVID lows, when the Fed and the central bank started getting involved to prop up these markets, and the plunge protection teams come into consideration, you can see there very, very quickly the Dow Jones rallied 100%. Now, that is very unsustainable over the longer run when you see an index rallying 100% without any sort of significant pullback. So if we fast forward now to 2 years down the line, what's happening now? Or what's the kind of the main storyline or kind of narrative that's pointed into the markets? Well, the main narrative is ultra high inflation. So you saw it there the other day. In fact, yesterday, in fact, should I say, in the US having 9.1% inflation. So the reason why the inflation figures are as high as they are and prices are as high as they are is a direct consequence of all this liquidity that was pumped in during this 12, 18-month period. And the narrative poses that when you artificially pump money into circulation, into the economy, you will have, as a result, inflation as a direct consequence of that. And as a result, then, additionally on that, we have seen the prices of goods, energy, food, you name it, it has rocketed up, particularly speaking in the last 9 months. So as a direct result, when you talk about this new narrative being pushed into markets regarding inflation and negativity associated with inflation, like higher prices, higher energy prices, higher food prices, everything associated with that, as a result, that's going to bring on negativity into the broader economy. Why? Because from a household perspective, but also from a business perspective, there's going to be less, I suppose, available capital to pay for expenses. So if you think that, right, there's a couple of examples there that the mortgages, let's say in America, right, 12 months ago, the mortgages on a 500K property off a 3.5% loan or 3.5% mortgage rate was sitting at around about $900 to $1,000 per month, right? As a direct consequence, now that same mortgage is working out at around about $1,950 to $2,000 a month. Okay, so you can see as a direct consequence, because of these higher prices, people are spending a lot more on the different goods and services to run the household or run the business, and as a result, then the margins, or I suppose the profitability within the household, both from a family perspective, but also from a business perspective, will diminish greatly as a result. So what we're seeing now is, as we know, ultra high inflation, and we've got inflation in the UK. I think it's next week. I think it could be next week, next Wednesday. I just have to double check the calendar. All in the UK, kind of looking at 9.1, 9.2, 9.5%. All right. And if I even show you that screenshot that I've just posted in the discussion group, this is exactly what we're talking about, right? This narrative of higher inflation is absolutely killing these markets, and it's going to continue killing these markets until such a time that they start going from 7, 8, 9% back to 6, 5, 4%. Until we start to see the inflation figures coming back into 3s, 4 handles, it's going to continue to add pressures into the market. Now, the next thing I'm also going to say there is, having higher prices of services and goods will also mean lower growth figures. Now, we know last month, our last quarter, the US economy revised GDP is negative. On the end of this month, we are also looking for another negative figure in the US economy. Now, Charlie Bilello, the guy that I follow quite a lot in terms of data, states that not necessarily will the two negative back-to-back quarters will lead to a recession in the US, because normally speaking, the old narrative was 2 consecutive quarters of negative GDP equals recession, right? So it's looking very much likely that in 2 weeks' time, we're going to get 2 back-to-back quarters. But in the anomalies and in the calculations in the US now, they factor other things like earnings and home earnings, company earnings, and they factor in a few other different bits and pieces into those calculations, and I'll supply those afterwards in the discussion group as well. So it's just a case of understanding that at this moment in time, we are in a very, very difficult period of time in terms of inflation, in terms of the onslaught of what happened over here during this period of time. And as a result, we are going to be sitting on lower growth figures. Probability now that I would say is recession is pretty much all but certain, in my opinion. It'll be an absolute miracle, I think, if the markets avoid a recession over the next 6 to 12 months. And also factoring in that this idea of lower stock market prices is probably going to continue. Now, the reason why I would be surprised if it didn't continue is the fact that at this moment in time, with these massively high inflation figures of 8, 9% across the board, the only way to tackle high inflation prices is to increase, well, firstly, cut fiscal spending in terms of governments. So obviously increase taxes, cut public spending. But the other narrative with that as well is also increasing the interest rates. And we saw it there yesterday with the Bank of Canada. They increased the rates by 150 basis points. Now, as a direct result of that, and with the Fed obviously looking for another increase at the end of the month, we're seeing interest rates now increase sharply globally, right? ECB will now be getting interest rates, net increasing interest rates for the first time in like nearly 2 decades, or like 15 years or something, next week when they start to increase the rates. So we just have to factor in that, yes, when you factor in obviously the massively high inflation figures, you're going to have massively higher prices in terms of goods and services, but as a direct consequence to target this high inflation, it means slightly more pain in terms of net spending by households, etc., because of the increase in interest rates, because that's the only way that governments, central banks can maintain stable prices, by increasing interest rates. Now, the problem is when you increase interest rates, the cost of borrowing goes up for those on variable loans, mortgages, etc. So that's going to put even more pain on some of these households and other businesses who are trying to finance debt. So we just have to factor that into consideration. At this moment in time, it is obviously extremely difficult. Now, that is from the inflation, growth, economic pieces of data point of view. Now, again, if you go into the economic calendar, I'm just using the FX Treaty economic calendar here as an example, okay? So if I type in, let's just say, for example, this month, I'm going to filter it, and I'm just going to knock out everything apart from inflation and interest rates, okay? Because those are kind of the two things that people are looking at. Yes, you can look at employment data. Yes, you can look at growth, GDP figures. They're also important as well. Anything that is a leading indicator is systematically important to the economy. So, for example, tomorrow we have retail sales coming out in the US, so that's going to be important, because if the retail sales starts to diminish and starts to drop, that means there's not as much money being spent by households, spent by people in the economy. So that's obviously going to lead to contraction in terms of growth. Okay, so you also have to factor that into consideration. So if you look at any of the most recent central banks, right? For example, here we've got RBA on the 5th of July, rose rates. Okay, what are we seeing here in PPI and CPI indexes? Obviously creeping higher as well. So you can start to see that this narrative is very much circling through. And if I just toggle through this list, you can even take them one by one, right? If we take them, Kiwi interest rate, 0.5% increase there on Wednesday, Tuesday night into Wednesday morning. Okay, again, CPI in the US yesterday, 9.1%. So to counteract these super high inflation levels, they're going to have to increase the interest rates, which obviously means higher exposure to debt repayments, and obviously negative growth as a indirect consequence because of sentiment and because of less money being available for people to, I suppose, spend and utilize in the economy. So next week, for example, next Wednesday, we've got the pound CPIs. So again, 9.6%. That even shows that even the previous forecast was 9.1. Next week, they're looking at 9.6. If that's breaking through 9.6, you're probably going to see even further selling in the indices. You're going to see probably the pound, the FTSE struggle, and you're going to see the markets generally move to risk assets or safe haven assets as opposed to risk assets. So that now brings up the conversation of safe haven and risk assets. So what are we seeing then over direct consequence? So basically, to, I suppose, determine how these markets are simply working at the minute, right? There is two ways or two, I suppose, areas to look at in terms of these current financial markets, right? The first is looking at the broader stock markets, okay? Secondly is looking at the correlated currencies. So the reason why I'm using the US example is because it's the easiest and it's the cleanest to understand. And the reason why I'm focusing on the US example as well is because the US dollar is, as we know, it's the global reserve currency. So in terms of a mechanism of safety by investors, hedge funds, major institutions, the hedge is going to be into the dollar because it's a safe haven. So traditionally speaking, we would have classified safe havens as the yen, the Swiss franc, and the US dollar. Now, the Swiss franc is still technically a safe haven, in my opinion, whereas the Japanese yen at the minute isn't. And the reason why the Japanese yen isn't a safe haven at the minute is because the Bank of Japan has a very divergent monetary policy. And what I mean by divergent, I mean it's not increasing interest rates, whereas every other economy is. Now, the reason why Japan isn't increasing its interest rates because it has got a low growth and it has low inflation. pretty much since the last 40 years or so. So you can see as a direct consequence that when other central banks are increasing their interest rates, they're making their currency stronger than that of the yen. And hence why we're seeing Japanese dollar yen of 137, 138, pound yen at 165 or whatever it is, euro yen at 135 or 140. So it's a direct consequence that the yen G7, G10 is the weakest currency at the minute because its central bank hasn't had the need or requirement to increase their interest rates because of high inflation environment. So that's why if you're wondering why the yen is weaker than everything else, that is systematically why. So for this example, as I said, we're going to be looking at the dollar and the US indices, right? So I'm going to put the indices on the weeklies just to drive home and I suppose kind of show you the narrative on the broader timeframes. Yes, you can look at the shorter timeframes. That's obviously important too, but understanding that broader narrative, I think, is ultimately more important. So when we look at the dollar over the last 2 years, again, driving home that kind of discussion point we've mentioned over the last 10 or 15 minutes or so, as the indices are rallying significantly over the last 2 months, right, it meant that investors, hedge funds, institutions were applying an extreme market risk to the markets. The reason why that was the case was because obviously the Fed constantly increasing or introducing liquidity into the markets, pumping up the markets, and as a result, only people were buying stocks. No one was buying anything else apart from stocks, your tech stocks, your growth stocks, your Apples, your Amazons, your Microsofts, you name it, people were buying it. And as a result, then, because people were buying the stock markets, there was no need to be putting money or capital into safety assets. Why? Because the sentiment and the appetite was that there was massive aggression in the markets by participants. And as a result, the dollar wasn't required. People weren't buying the dollar. Okay, because as we know, the dollar is a safe haven asset. So when there's no safety applied to the markets, the dollar will be weaker until such a time as there is a U-turn or a reversal in those sentiments, right? What do we see here at the beginning of the year? Dow Jones, if I zoom in, just kind of focus on this area here. You can see here, beginning of the year, literally the start of the year was the high in the Dow Jones. We're off from 36,500 all the way back to 30,600. Okay, so that's a 6,500 point sell off in the Dow Jones, right? So if you want to look at your metrics, your calculations, the Dow Jones from its local lows is off 20%. The S&P in comparison is off probably a little bit more. I would say it's probably off about 24, 25%. Yeah, not far off, roughly just 24%. And the NASDAQ, I think, is off even more. I think it's off nearly, I think it's off about 30, 32%. Let me just check this out from the calculation perspective. Yeah, not far off, 34%, even worse. So what's actually happening now is because the indices are moving lower, people are moving out of the risk aggressive asset classes. And again, this is probably one of the reasons why the cryptos have sold off so much over the last 6 months or so, because of the safety attached to riskier assets. So people are moving out of those riskier assets, moving into your safe haven. And as a direct result now, the dollar has absolutely poured supreme. So this is the reason why today at the minute, the euro is literally fighting its tooth and nail against the dollar at parity, right? We broke through parity today and the euro went to 99.70. We've come all the way back up to 100.20, 100.40. And it's literally a massive tug of war at parity. So during this, then you're seeing obviously the dollar ramp up as the safety assets, right? People are just continuing to buy the dollar because they see more fear in the markets, they see more risk applied to the markets. And as a direct consequence, then people are just continuing to apply a narrative of let's just buy the dollar, buy the dips, buy the pullbacks, and sell out the stock markets. And you're seeing higher highs and higher lows from a trending price action perspective, higher highs, higher lows in the dollar. And at the same time, you're seeing the exact opposite effect in the indices. Lower lows, lower highs, lower lows, lower highs, lower lows. Okay, same here again in the NASDAQ. Lower lows, lower highs, lower lows, lower highs. Okay, similarly, very, very clear. Same again here in the Dow Jones. So the narrative here is out of stock markets, out of riskier assets, into your safer asset classes like your dollar, like your hedging instruments, even your bonds, your treasury yields, are other asset classes. However, this time around, and this is where I was sharing with you in the last couple of weeks, how even the bond markets have been getting hit. So people have just been pumping their money into cash, into the dollar, and holding dollar, even though they're taking an 8 or 9% loss in terms of the inflation, in terms of the buying power. They would rather take an 8 or 9% loss by holding cash than holding stocks and taking a 30 or a 40% loss on some of these aggressive indices like the NASDAQ, for example. So it's just important to be able to drive that home. So the next calculation then is obviously looking at when you look for weaker indices, you're looking for stronger dollar or stronger safe havens. So that's obviously why we're saying there, if the S&P is stronger or moving higher, your dollar is moving down, and vice versa. So when your dollar is moving higher, your S&P, your indices, and everything else in between, from a risk perspective, is going to be weaker as a direct consequence of that. So it's just knowing how these markets react. Now, again, I would have said, normally speaking, if you're trading gold or you're trading oil or any of these commodities, we're starting to see a peak now come into the commodity prices. So gold has kind of falling off a cliff again against the dollar. And the reason why gold is falling off a cliff, if you're looking at that chart, is because, again, dollar strength. It's not because of people wanting to buy gold. It's because of the gold pricing against the dollar. And as the dollar continues to remain supreme and continues being stronger, that only leads to a weaker dollar or weaker gold prices as a direct consequence. So it's just knowing how these markets react in a cause and effect scenario to be able to apply logic, broadly speaking, beyond that. All right. And again, if you're looking at the FX markets, the reason why we say there you look for the Aussie and the Kiwi and the Canadian dollar as risk on currencies is because those currencies apply what I would call or operate in what I would call risk I suppose markets. Now the reason why I say that is because Aussie, Kiwi and CAD all export large amounts of commodities as a main contributory to their global growth. Okay, so to their economic growth. For example, Australia, large amount of metals, New Zealand, metals and milk and other kind of commodities. And in Canada, you're talking about the oil markets. So when you see the oil markets there, the oil prices on WTI come back from 120 to 95, as a direct result, you're seeing weakness in the CAD. So if you look at USD CAD, for example, you'll see today USD CAD has gone from 130 to 132 and has broken out of a massive range. So that's illustrating there that you're probably going to see a longer term, medium to longer term run in the dollar CAD back into 136, back into 137 as a direct consequence because of the decline in the commodity prices. You only have to look at corn, you only have to look at any of the kind of really kind of volatile commodity assets, and you're seeing how the pricing in those has dropped significantly over the last 4 or 5 weeks or so. So it's just applying logic beyond that as well. All right. So again, obviously with the gold prices, gold up, Aussie up, Kiwi up, they're generally all correlated together. And that's why we term them, there's two terms for these markets right now. Risk on, stocks and indices are rallying or increasing, which is what we saw over the last, let's say, 2 years or so, into now where we're seeing consistent pegs of risk off narrative posed in the markets where the dollar, the safe havens are rallying or increasing. All right, so that's effectively it in a nutshell. So it's just understanding these dimensions. And of course, as well, you're probably wondering, well, with all the central banks increasing rates now and continue to increase rates. So, for example, now my statistic, my reference point for the end of the year on the Fed is that interest rates are probably going to be somewhere between 3.5% and 3.75%, using statistical data, using the greater scheme of the economy, and looking at the broader markets as a direct consequence. So when you factor that into a potential where central banks are going to be at 3.5%, 3.75% using dot plots and other pieces of economic data to support that, that means there's probability of more bearishness coming into the markets becoming even more pronounced. And that's why I would be looking at the likes of these pre-COVID highs from February 2020 as medium to longer term 6 to 9 month benchmarks and pricings over the next, I suppose, into the second half of this year and obviously into the year end. So you're seeing S&Ps potentially at 3,400, 3,300. You're seeing the NASDAQ at kind of 9,500, and you're seeing the Dow Jones at probably, I would say this is probably even going to go below because this is the worst performing of the lot, and you're talking 29,500. So we're only 1,000, 1,100 points away from that already. But it would not be surprising to see the Dow Jones go 27, 28,000. And if that means that's going to happen, it becomes an even more systemic sell-off in these markets. Now, the other thing I was going to say, just when we're looking at these pieces of information, I do also want to go through some of the bits and pieces that I've been sharing over the last couple of weeks or so in particular. So when I look at obviously the inflation prices, but when we look at everything else beyond that, okay? So just give me a second, guys. I'm just going to open up some additional charts or additional pieces of information, and we'll look at those as well. Okay, so let's look at this as well. So in this chart, right, this is basically the net performance of the stock market over the last 40, 50 years. Okay, so the total returns, the aggregate total returns in a hedge where you buy 60% of your portfolio in stock markets and 40% in the bond markets. Okay, so 77 to 2002, it shows that not very often do we get this rapid decline. So normally speaking, when you hedge, you buy bonds, you buy stocks, every year on annual, you end up with a return of somewhere between kind of 8, 10, 12%. Now, some years you'll end up even better, kind of 24, 25%, alluding to 82, 85, 97, 98, 95, even 2019 as an example. But this year is becoming the anomaly, like matching of 2008, where we have significant declines. So it just shows at the minute there's no places to hide in these current markets, because you're seeing the bond markets getting hit, you're seeing the stock markets getting hit, and that's why so many people now are hedging into cash. And by hedging into cash, what are they buying? They're probably buying dollar cash indexes or something related to that. Now, even you're seeing the euro getting hammered, you're seeing the pound getting hammered, you're seeing the Aussie getting hammered, the Kiwi getting hammered, the yen getting hammered. So because of this at the minute, that's why everyone's buying the dollar, because as we know it, global reserve currency, it's where the most amount of reliability and safety in these markets can be applied to and attributed to. So it's just important to be able to recognize that as well. Now, when we look at the next piece of information is something else I want to show you. So this is again showing you the 60-40 average. So again, applying, so if you invested in every year that there was kind of a recession, so 77, 81, 90, 2000, 01, 02, 08, and 18, every time that there was kind of a bear market or kind of decline, it showed that this was the average return in the stock market, the S&P 500. Okay, so the average return was 7%, 5%. So you can see it there year on year, the different growths. But 22 year to date, 20%. So it's showing how ferocious and how volatile these markets have been, and how much damage all the liquidity that has been pumped into the markets over the last year is currently having on these markets. Okay, and even again, this year is the only year where the bond markets, the Bloomberg Barclays US Aggregate Index, for example, it's the only year showing where these markets are getting hammered. So that's why I'm saying there's no hiding in the indices, there's no hiding in the stock markets, there's no hiding in the bond markets. So you just have to be conscious of that as well. So the other things I want to look at then is this as well. So this basically shows that this is basically every recession or every kind of bear market, bear market and recession since 1929. So it shows that when you factored in every market decline since 1929, since the Wall Street crash, the average length of a bear market, as in declines, is 14 months. Now, the market started to decline in January. So we are now in month 7 of this. So you can see already a lot of the most recent bear markets, 2020, 2018, 2011, 98, 99, so on and so forth, back as far as, with the exception of 2000, 2007, we are now in probably one of the longer run bear markets. So it's probably not going to be surprising to see this bear market last for 12 to 18 months minimum. I would be surprised if we were out of this by Christmas. I would actually be probably saying that the markets would probably bottom out. I would say kind of February, March of next year is a realistic time frame for when these markets are probably going to bottom out. Now, the NBER, which looks at recession, so this is for every recession that's factored in. So recession, obviously slightly different. So as we know it, negative growth, back-to-back negative growth, and everything that comes with it. We have seen how the market declines has factored in for each recession. So 2020, we had 35% drop. So 2007, 2009, 58% drop. 01, 51% drop. 91, 20% drop. So the average decline during these periods of times is accumulated to 36%. So given that the NASDAQ now is 33, 34%, and they're just the tech stocks. So when it says the average percentile, that's looking at the broader market, not just the NASDAQ. So that's looking at, let's say, the S&P. So the S&Ps at the minute is approximately 24% down year to date from the absolute lows, from the peak to the absolute lows, which is showing that still another 14 to 15% on average minimum still left to come in this. So when you factor in another 10 to 15% decline of the S&P 500, probably coming into somewhere between 32 and 300. So you can start to see now how some of those price points that I alluded to is now being factored in reality in terms of how far the markets could potentially decline. So it's just understanding that as well. So that's just a few pieces of information that I wanted to go through. And of course, the last thing I wanted to go through was how different the economic cycles are reacting now to, let's say, any time over the last 40 years. So if you look at 87, you look at 1998, 2002, 09, 11, 18, and 20, what happened? What was the kind of the common denominator in every one of these? The Fed was able to cut the rates. So it went from 7 to 6.5, 8 to 3, 5 to 4, 6 to 1, 5 to 0. But this time around, they don't have that ability. And the reason why they don't have that ability is because they cut rates during COVID to stimulate and artificially kind of recreate kind of a bull market of these markets. And then, of course, now with that stimulus, with the lower rate environment, they are not able to use interest rate cuts as a tool to curb this decline or market decline because of the inflation levels. So what you have to do to bring inflation down levels is first is bring up your interest rates to bring the inflation back down, and then quickly pivot to a more gradual rate of interest rates. So what they're probably going to do is increase the interest rates to, let's say, 3.5%, 4.5% to bring that inflation level back down, and then over time quickly then pivot and have your interest rates sitting somewhere between kind of 2.5%. That was the Fed's goal all along. Have interest rates 2.5% in a normal environment, normal kind of financial environment, to allow the inflation figure to sit somewhere at or close to those levels as well. Now, the only way to bring the inflation back from 9.1% is to cause demand shock. So effectively what the Fed are doing now is trying to put the economy into recession to bring those inflation levels back down, have 6 to 12 months of fairly strong pain in terms of households, in terms of business, in terms of actual growth, then look to reset, and then look to go again. In essence, all right. So that's pretty much it in terms of that, and you can even see it here as well. If I go through one last piece of information, which is this, it also looks at the consumer price index, be the federal funds rate. So if you look at the 1980s, when the federal interest rates, but the last time when the kind of the interest rates, or sorry, the last time when the inflation rate, should I say, was at kind of 9.1%, the interest rate was, roughly speaking, a lot higher than that. So the last time the interest rates or the inflation rates, as I said, in 1981 was at 8.5%, 9%, you had the federal funds rate somewhere between 12 and 13%. So you can see how this time around they have a 9% inflation rate, but the Fed funds rate isn't at 13%. It's at a mere, 2%, 2.5%, and probably somewhere, could even be 3% by the end of the month, depending on how aggressive they are. But let's obviously wait and see. Okay, so at this moment in time, they're looking for probably somewhere between 2.5 to 2.75 by the end of the month. The Fed could go a little bit more aggressively. They could maybe try to increase it sharper to counteract obviously this headline inflation that we're seeing in July, yesterday. But it's just important to be kind of conscious of that as well. All right. So that's pretty much it, guys, in terms of the correlations within the markets, how we look at the broader markets in relevance to what's happening in real time. So in terms of inflation, in terms of growth, I suppose the other kind of dimensions we kind of look at from economical data will be like your retail sales, will be your manufacturing reports, your PMIs, your ISMs, and also your employment figures. Now, the only problem is that the employment figures is actually giving a skew on the current markets, because at this moment in time, the job openings are still fairly high in the US. And the reason why the job openings are still fairly high in the US is because of what happened during COVID. So the amount of people who have not returned to work, who've simply just retired and dropped out of the labor force, is monumental. And as a result, now there's that many availabilities to cover up those spaces that we're not seeing people lose their jobs as in terms of what would have happened in 07 and 08 because of the amount of people retiring and not returning to the workplace. So you also just have to factor that into consideration as an indirect consequence of what's happened during COVID as well. All right. So that's pretty much it in terms of the fundamentals. If there's any questions there, we'll open it up or whatever, but I'm just going to stop this as well.